This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Today, we had, I don't know if he's the most high-profile, well, in our world, the most high-profile guest that we've had to date, probably, right?
Certainly one of the highest-profile guests.
Yeah. So we had Larry Swedroe, and he literally wrote the book on everything that we talk about. Factor investing, index investing, the evidence, portfolio management, asset allocation, you name it, he's written a book on it. He just released in early January of this year his newest book, which is on retirement planning. And Larry, as always, takes an evidence-based approach. So he wrote this phenomenally well-written book on, I'd call it evidence-based retirement planning, but everything from asset allocation as per usual, but also how you should live your life and how you should approach the psychological aspects of retiring. It was fascinating.
Yeah, he's an amazing guy. He dedicated a lot of time to us. He was in no rush at all. He'd probably still be going if we had the time. And he's always been gracious. Even when I reached out to him back in 2003 to speak for us, he was very gracious. Flew up from St. Louis to be with clients. And he's done that 3 or 4 times over the years. Just a very giving, nice guy.
And Larry, I guess we should talk about who he is. He's the director of research, right, at Buckingham
Strategic Wealth, which is a very large RIA in the U.S. They manage $12 billion in their own RIA, which is impressive.
Yeah, and Buckingham's huge because they've got Buckingham Strategic Wealth, and then they've also got the Buckingham Alliance, right, where other RIAs can plug into. And
I think that's another 30 or 40 billion on top, I believe, that they did the back end for. And
Larry writes, if you Google anything about the kind of stuff that we talk about on the podcast, Larry's going to be on the first page, whatever the topic is.
Yeah, he's very active on Bogleheads. I believe he's been on NBC, CNBC, CNN, Bloomberg. He writes lots and lots of articles on all kinds of different investment subjects.
Yeah. Anyway, his thoughts generally align very closely with ours, so it was fun to ask him some of the questions that you hear maybe Cameron and I talking about with each other. Good to hear a third perspective on the similar topics.
And also questions that we've got from listeners, so it was good.
Yeah, it was a good episode, so we'll head over to the episode.
Welcome to the podcast, Larry.
Thanks very much. Great to be with you and Ben.
We have a handful of questions for you related to your most recent book called Your Complete Guide to a Successful and Secure Retirement. And then after that, we'll have some questions related to your other work over the years. Can you, first of all, talk about why retirement today might be more challenging than it has been in the past? Or I think you described it in your book as the 4 horsemen of the retirement apocalypse.
Yeah, the U.S. investors in particular, I can speak to, have really been blessed having lived through a period where both stock and bond returns have been very strong. Over the very long term, a conventional 60-40 portfolio since 1926, when we have data, has returned about 8.5% or so. And over the last 36 years, this golden era since 1982, they actually returned over 10%. So that has allowed investors to build large portfolios to provide for a successful retirement. Unfortunately, we're now faced with much higher equity valuations than historically the case, and high valuations unfortunately forecast lower expected returns. The more you pay for earnings, obviously the lower the expected return should be. And the financial crisis we faced in 2008 and what's happened since then has driven bond yields to exceptionally low levels, so that most financial economists today think U.S. stock returns are going to be in the 6 to 7% range. Intermediate high-quality bonds are at about 2.5%. So a typical 60-40 portfolio, instead of providing over 10% as it has over the last 36 years, is much more likely to be in the range of maybe 5% or maybe even a bit less. So you have the two dual hurdles of higher equity valuations and much lower bond yields, meaning you're going to have to save more because your returns are expected to be lower. Those are two of the horsemen. The third is kind of a good news, bad news. The good news, of course, is we're living much longer. When I was growing up, I didn't know many people in their 70s. And today, typical 65-year-old couple, average life expectancy of second to die is almost age 90, and that means half the time someone is going to be alive longer. So you have to plan on today 30 years, I think, at least. So you need the money to last longer. So that means you're further challenged. And lastly, because we are living much longer, the odds of needing long-term care at some point jump dramatically once you become a senior citizen. So much so, by the time you're in your 80s, if you were to live that long, more than half the population will need long-term care. And complicating matters even more for U.S. citizens anyway is the fact that Social Security, if the government doesn't take action, in now just 13 years, will only be able to pay out 75% of the promised benefits. So you may have that fifth horseman of the apocalypse yet to face.
That's so interesting, Larry. In the book, you go over the 9 most common retirement planning mistakes that you see. If you had to pick the single most harmful, which one would it be and why?
Pretty hard, but I think I would choose this one. One of the biggest mistakes that I see investors make is that they think of their expected return of their portfolio in a deterministic way. For example, I expect to get 7% from my portfolio. And they think of it, I'm going to not only get that 7%, kind of like with certainty, but they also think they're going to maybe get it every single year, which obviously is not correct. And what investors fail to understand is that when you're in the accumulation phase, the order of returns doesn't matter as much as it does in retirement. Because in retirement, if you retire and immediately you face a bear market, you can't recover from funds you have spent. And so retirees face what are called sequence risk. The only right way to think about expected returns instead of as one particular number is to think about the typical bell curve, a normal distribution of returns where your expected return is just the median. And if we think about using a Star Trek term, alternate universes that might appear, let's say you had 5,000 possible alternate universes you might live through, that 7% expected return is the median outcome of those 5,000 and may mean that 40% of the chances you'll get 8% or more, 20%, 9 or more. In the US, if you were lucky and you retired in 1980, the next 20 years you got almost 19%. If you're in Japan since 1990, you've had negative returns for now 30 years, so you're in the left tail. The only right way to think about financial planning is that you have to build a plan that incorporates the possibility of any of those outcomes in that distribution could occur. And the failure to account for that sequence risk leads too many people to spend more money than they should be in retirement, and to not building a large enough portfolio, maybe retiring early as well.
So interesting. We do a lot of that kind of randomization work with clients, as I know you and your firm does. Now, this really focuses on the numbers, but if we think of non-numerical things for a second, what do you think are the most important non-financial elements that people should be thinking about as they head into retirement?
That's a great question, Cameron. And the way I answer it sort of when I'm talking to people is I tell them, first rule is you should never work with an investment advisor. And then they look at me like, what are you talking about? And I say, the reason you don't want to work with an investment advisor is because a perfect investment plan, if there was such a thing, can fail for reasons that have nothing to do with investing. A classic example is I met with a young advisor, someone probably around the same age as Ben. This was about 20 years ago. He had 3 young kids, and he asked me to review his financial plan. And I thought the investment side looked good. I made a few suggestions. And then we did a needs analysis on his insurance, and we found he was woefully underinsured. The typical cobbler's son without shoes. And we convinced him that he should go buy a multi-million-dollar declining term life insurance policy because that would meet his needs in the lowest cost way. As he worked and earned and saved money, invested it, he would build up assets, and each year that went by that he had income and was paying for expenses, the needs for the family would be reduced along the ways. The good news was that he took our advice. The bad news was, sadly, he was dead a year later of cancer. So an investment plan clearly can fail for reasons that have nothing to do with investing. We've seen many examples. I'll just give a few. We have a young man gets married quickly, divorced with a short time, remarries, has a large family. 30 years later, he dies, and the beneficiary of his retirement plan is the first wife. And in the U.S., there's nothing you could do about it at that point. You have a teenage son or daughter, they get in a car accident, and you don't have an umbrella policy or what's called an excess liability policy, and your financial wealth gets devastated in a lawsuit. Most high net worth people I know pay high-powered attorneys to draw up estate plans that do a great job of minimizing taxes. But they fail often to, for example, fund the very trusts that are set up, or they put the wrong assets in the wrong type of trust, or they, while minimizing taxes, they don't fulfill the life goals for the family. So there are many issues, including the last chapter of the book, that relate to elder care and the risk of abuse because of cognitive decline as we age, and the importance of addressing that as well. You could spend your life building up these resources, and then some con artist takes that money away from you because you're not aware and don't have the cognitive skills to protect yourselves any longer. So you need documents that can protect you.
I want to tack a little bit more onto the question that Cameron just asked, Larry. You kind of talked about some non-investment factors that retirees may not be thinking about. But in the book, I think it's the first chapter, talks about all of the completely non-financial factors that retirees might face that they probably don't think about enough. So that's things like, one of the examples in the book was actually planning out what is your day going to look like in retirement. Can you talk a little bit about some of those completely non-numbers related factors that people need to think about when they're heading into retirement?
Yeah, it's really sad that while none of us would start a business without a business plan, so many people begin investing without an investment plan, and likewise, they begin retirement without thinking through what a successful life in retirement would be. What's that ideal day look like? And what we do know is this: because people get so much of their sense of their self-worth and fulfillment in life out of their work, it's very typical. We have our social connections there. We get our intellectual stimulation there, that when we retire, we lose both of those two things, which are critically important. And then what that leads to is incredibly high increases in rates of depression. It leads to incredibly high divorce rates. The fastest growing rates of divorce are in what are called the silver divorces now. And the highest rate of suicides, at least in the U.S., is now among elder men retirees because they have lost the meaning in their life. I recruited someone who I thought had written a great book, Alan Spector, Your Retirement Quest, to help me write that chapter, to help people think about this very important issue. And I would think that most spouses would want to force their spouses to read the book, because there's an old saying, I married you for better or worse, but not for lunch. And that's part of the problem why there are so many divorces after retirement is people don't know how to live together because they don't have this purpose in their lives anymore. So it's so important, and that's why we made it the first chapter of our book.
Yeah, it struck me as really meaningful just because, kind of like you mentioned, most people aren't thinking about that or writing about it. When you're reading a retirement planning book, you don't expect to see that type of information. So I thought that was extremely valuable. Now, one of the things that, of course, there was a chapter out of the book was asset allocation, which is one of the things that you're best known for. Now, we on this podcast and with our clients talk a ton about factors and products from companies like Conventional Fund Advisors, which employ the factors, obviously. Can you talk a little bit about how important exposure to those independent risk factors are?
Yeah, so I think the way to best explain this is the following. So, and this really goes to the heart of our whole investment strategy. So our basic belief based upon the evidence is that markets are highly efficient. By that we mean that while we don't know exactly what the right price for every stock or bond or currency or commodity is, we believe that the market's estimate of the right price, the one it's currently quoting, is most likely to be the right one. And that means that efforts to time the market or pick individual stocks are highly unlikely to succeed. When I wrote my first book in 1998, Charles Ellis had written a book called Winning the Loser's Game, and he called active investing the loser's game because he said the following: 20% of active managers were at the time generating statistically significant alphas, outperforming risk-adjusted benchmarks, with 80% underperforming. So he says, I don't like the odds of winning a game where it's 80% against me, and that's pre-tax, and active managers generate a lot more taxes. So we have this game where it's possible to win the game of active management, but the odds of doing so are so poor, it's not prudent to try. I wrote a book recently called The Incredibly Shrinking Alpha, which shows, based on the latest research, that only 2% of active managers are now generating statistically significant alpha. So the odds of winning that game have dramatically come down. I don't like games where the odds against me winning are all about 50-1. So that's our first premise, that we should be passive investors, meaning accepting market returns. If you believe that the markets are efficient, your second premise should be that all risky assets should have similar risk-adjusted returns. That doesn't mean similar returns, but similar risk-adjusted returns. So small caps are riskier than large caps. They should have higher expected returns. It's not a guarantee, of course, so there would be no risk, even over very long periods. Emerging markets are riskier than U.S. stocks or Canadian stocks, so they should have higher expected returns. But once we adjust for risk, all risky assets should have similar risk-adjusted returns. Otherwise, cash would flow into the assets with higher expected returns, driving their valuations up and future returns down, and money would flow out of assets with lower expected returns on a risk-adjusted basis until we reached an equilibrium where all risky assets had similar expected returns. Now, what does this have to do with factors? Factors are nothing more than unique or independent sources of risk. What most investors don't understand, if they're sitting with a typical 60-40 portfolio, and I'll use a U.S. investor as an example, they're sitting, say, with 60% in the S&P 500, 40% maybe in an intermediate bond fund. And if I ask them how much of their risk is in U.S. equities or this market beta factor, they say 60%. And I point out that that's wrong. It's almost 90%. And the reason it's not 60% is that equities are far more risky than safe bonds. The volatility of stocks is about 20. The volatility of safe bonds intermediate is about 5. So if we do a little math, you could see 60% times 20 volatility. That's 1,200 risk points. You only have 5 volatility and 40% bonds. That's 200, 1,400 total risk points, of which 86% are in that one factor called market beta. So we think, therefore, because small stocks have the same risk-adjusted returns, we should allocate more to small stocks than the market. We want to add value. We want to add international stocks. And we want to add as many unique sources of risk as we can identify that meet the criteria that we established in our book, Your Complete Guide to Factor-Based Investing. So that's really key. One last point, why you really want to diversify. This makes a great example. I think most people would be shocked to hear these statistics. We have had at least 3 periods of at least 13 years where U.S. stocks, meaning market beta, underperformed totally riskless 1-month treasury bills. The longest was 15 years, from 1929 to 1943. We also had 1969 through 1982, that's 14 years, and 2000 to 2012. All 3 periods, 1-month T-bills outperformed U.S. stocks, and very importantly, in each of those periods, there was a significant and sizable size premium and an even more significant and larger value premium. So diversifying across those factors led to stronger portfolios. And the last thing, which is covered in my book, which I recommend, Reducing the Risk of Black Swans, because small and value stocks have higher expected returns than the market, you can own less equity risk overall and more safe bonds because the equities you own have higher expected returns. And what that does is it really pulls in the left tail of the potential dispersions, reducing the losses in years like '08, because while safe bonds have no correlation to equities, in bad years like '08, safe bonds tend to go up in flight to quality. Their correlation turns negative. So in '08, a high quality bond fund, US, was up 10 or 12%. And so you are owning less equities, which dropped sharply. So your losses were less on that portion. And you own a lot more safe bonds, and that went up. So our clients experienced far less losses in '08 than they would have if they owned a typical market-like portfolio.
So there's a question I've been dying to ask you for a while, because as Ben mentioned, we talk about factors quite a bit on this show, and we get lots of listener questions on factors. Is there ever a situation that you can think of where you're better off without exposure to factors in your portfolio?
Here's the way I would answer that question. I think there are a very small group of people who would be better off. It's those people who cannot live with this, what I call dreaded disease known as tracking error regret. So once you decide to diversify a portfolio, adding these other factors of small and value and international assets. In our case, we add exposure to other sources of risk like reinsurance and consumer and small business lending. So we want as many of these unique sources of risk as we can identify. Once you add those factors, you're not going to look like the market. And that means you must accept the fact that there are going to be long periods of underperformance, regardless of which asset class or factor you're in. So I mentioned in the prior answer that we had 3 periods where U.S. market beta was negative of at least 13 years. In the last 10 years, we've seen U.S. large value premium and small value be negative. On the other hand, the value premium was positive in international markets, but emerging markets and developed international markets have really lagged the U.S. So you're going to have to live through these long periods. But people forget that these things reverse and they only remember the most recent period. So as a reminder, I'll point out, so we can look back at 2003 through 2007, the prior 5 years before we went through this period where international and developed markets did very poorly. During that period, the S&P was up about 83%, so it had a great run. But developed markets, the EFI index, Europe, Australasia, and the Far East, they were up about double. And as an example, emerging markets were up much more, but the DFA Emerging Market Value Fund, which I own, was up 545%. Now, no one complains about tracking error when it's positive, but we all complain or tend to when it's negative. So if you can't accept the fact that your portfolio is going to go through these periods, possibly long ones, where it will underperform, then you should look like the market. Now, that's subjecting you to much more risk, in my opinion. First of all, you have to hold a lot more equity risk to achieve the same goal. And the second problem is you may be unlucky in that you have all of your assets concentrated in market beta just when you retire and your portfolio gets devastated. And just think of what's happened to Japanese investors who were worried about tracking error and didn't want to own international stocks starting in 1990. They suffered greatly. Whether you're a Canadian investor or a U.S. investor, you have to admit there's at least the possibility that your home country could be the next Japan.
Great answer, Larry. One of the things that we were talking about before we started recording the show was the comment that Cameron and I hear every now and then that says, well, I can't wait for the factors to deliver the positive expected returns. I can't wait 10 years for small cap to give me the outperformance that I expect it to over the long term. Is there any merit, other than tracking error, is there any merit to avoiding factors because you can't wait for them to deliver?
No, it's exactly backwards here. What people fail to understand because they're unaware of the evidence is that any one factor can go through very long periods of underperformance. And that's the point we make in my book, Your Complete Guide to Factor-Based Investing. We have a table that shows the odds of each factor having negative performance. Even the U.S., we estimate U.S. stocks, there's a 3% probability that it could underperform totally riskless treasury bills over 20-year periods. And as I mentioned, we've had 3 13-year periods where U.S. stocks have underperformed T-bills. So that can happen to one factor. If that's true, why would you want to run the risk that your portfolio is totally concentrated? Virtually all your eggs are in that one basket. That makes absolutely no sense to me at all. In fact, the shorter your horizon, the more likely it is you can underperform by very large amounts. And I'll give you one great example. From 2000 to 2002, the S&P 500 lost about 40%. Our equity portfolio, which is much more tilted to small and value and international, did lose money during that period. But our model portfolio, like you see in my books, only lost about 6%. So what if you retired and you were sitting with that period? You didn't have the ability to wait out and get the better returns in the long term. Your portfolio crashes because you retire in 2000 and are now withdrawing from that portfolio, and you can't recover from those losses with money that's already spent. People get this backwards. Actually, the shorter your horizon, the more important diversification becomes.
So there's a stat in your book, Larry, that estimates, and I quote, 70% of estates lose their assets and family harmony following the transition of the estate. So what should families be thinking about to avoid this situation?
Yeah, it's kind of interesting because this is a phenomenon that's global. There's an old saying, literally in over 100 languages, that we go from shirt sleeves to wealth to shirt sleeves again in 3 generations. So the first generation makes it, the second generation spends it, and the third generation, it's already gone and they lose it. And that's because the first generation that creates the wealth doesn't prepare the second generation properly to have the proper view of the value of money, and earning it and what that means, passing on the values that you had when you were young, and charitable intent, teaching your family and children how to manage and invest the money properly. So I'll just use my own personal example. I grew up my first few years sleeping in a kitchen in an apartment in the Bronx. We weren't poor in that we had enough to eat and no one starved. My wife grew up even in less favorable circumstances. And when I had a successful career and eventually helped build a company that got sold, we try to instill those kind of values and appreciation of money for our kids. So we didn't allow them to go out and buy, or we didn't buy for them a $150 pair of jeans. My wife taught them to shop at Target and wait for sales and things like. We didn't give them pony lessons, although we could have afforded it. And although I could have bought a new car every 3 years, I did want to enjoy the benefits of the work I put in and reap the rewards. So I bought myself a nice Lexus 430, but my car is now 14 years old, and we live in the same beautiful home that we have lived in for 31 years, even though I could have upgraded. So we wanted to instill those values, and that failure to do those things and educate your children and have those very important discussions. Unfortunately, in most societies, money is sadly a taboo topic. It's never discussed. And so we have a chapter in the book on the importance of preparing your heirs.
Yeah, definitely something that does not get thought about enough. Maybe with extremely wealthy families getting good advice, it does. But I think in general, families with wealth, but not substantial wealth, often don't think about that kind of stuff.
And I think that's one of the areas where a good financial advisor can provide help. We don't think of it that way. I'm sure most of our investors out there don't think of an advisor in that way. But that's one of the things we talk to people about, is how do you prepare your heirs, educate them. We hold training classes for kids to teach them about money. We help them write, and there's a sample family wealth mission statement in the book as well.
Okay, so up to now, we've been asking questions related to your most recent book, Larry. We've got a handful more questions related to the other work that you've done over the year, of which there is obviously a ton. So here we go. One of the most common questions that Cameron and I get, because of our use of the factors in client portfolios, as you do the same, the question that we get is, how much underperformance can a factor have before we stop following that research? Like if size underperforms for 10 years, at what point do you say, okay, we're not going to maintain exposure to size anymore?
I think there's a fairly simple answer to that question. The length of the period is really irrelevant. It may cause you to question your decision, but in my book, Your Complete Guide to Factor-Based Investing, which was co-authored with Andy Birkin, we established 5 rules before we'll invest in a factor. So number 1 is that we have to have very long-term evidence that the factor has delivered a premium across different economic cycles, different regimes. So, for example, in the U.S., we have data going now back over 90 years. We want to make sure that in rule number 2, we have evidence that it's pervasive. So the factor delivers across industries, sectors, countries, regions, even asset classes where it's appropriate. So, for example, value is buying what's cheap and avoiding what's expensive, and that works whether you're dealing in stocks, bonds, commodities, or currencies. We want to see evidence of robustness, and by that I mean it holds up to various definitions. So, for example, it doesn't matter whether you look at price to book ratios or price to earnings, cash flow, EBITDA. It doesn't matter. We get a value premium in stocks. In momentum's case, it doesn't matter whether the formation period is 3 months, 6 months, 1 year, 2 years, and what the holding period is, it holds up to various definitions. All these things reduce the risk that what we found was nothing more than a random outcome, a result of data mining. Fourth thing is that premium has to show that it survives implementation. So if microcap stocks delivered a 4% premium, but it costs you 5% to capture it, then we have no interest in investing. And lastly, it has to have logical risk-based or behavioral-based explanations for why we think it should persist. So in the case of stocks, for example, I would hope U.S. investors or investors around the globe did not give up on investing in U.S. stocks after any of those 3, 13 or longer periods where stocks underperform market beta, because there's a logical risk-based explanation and there's market beta premiums all around the globe. Yeah. But here's the interesting point, Ben. If you look at those 3 periods, they total 42 years. Now, we only have 92 years or so of data. That's 42 out of the 92 cumulative periods of negative performance. Hopefully, people didn't give up, because then they missed out on the 10% return that stocks provided. In the Factor book, we provide all of the explanations and the evidence for the size, value, profitability premium, and the other ones that your firm and my firms invest in. So unless you have reason to believe that the evidence has changed with the risk-based stories, then you should not give up. And to me, for example, small caps are simple explanations. They're riskier, more costly to trade, less liquid. You should have a premium for them.
So Larry, much of what we've talked about with you today is about portfolio structure, tilting towards factors and whatnot. In your country, certainly index funds have exploded in popularity, and enormous amounts of money are flowing into, companies like Vanguard. And much of their story, as far as I look at it, is about cost. Do you think this industry about index funds has skewed too far towards the cost story and less towards the portfolio structure story?
The way I would answer is this. Costs are important, but we should only look at only costs when we have something that's a pure commodity. So they're exactly identical. I would imagine, Cameron, that on occasion, maybe with your kids, you're taking them to some trip and a soccer event or whatever your team sports, you might stop and eat in a Subway or a McDonald's, but you wouldn't take your wife out for your anniversary to such a place. You would pick a nice restaurant. So there you don't consider restaurants a pure commodity. You didn't take your wife to the cheapest restaurant. The same thing is true of even similar passively managed or index type of funds. And the best example I like to give, and anyone can look on Morningstar data to see the point I'm making. So we would have, say, 3 similar small cap funds for U.S. stocks. You have small value here. You have Morningstar's small value fund. You have Dimensional Fund Advisors small value fund. And you have a fund we use in the U.S. called Bridgeway Omni Small Value Fund. Right. Now, the Vanguard fund is the lowest cost. DFA's in the middle, Bridgeway's a little higher. And if you went solely by cost, we would have chosen, obviously, the Vanguard fund. But we looked at it and we saw, and I don't know remember the numbers from 20 years ago, but today the Vanguard fund has an average market cap of somewhere in the neighborhood of about $3.5 billion. The DFA fund is about half of that. And the price to earnings and price to book ratios of the Vanguard fund are higher than that of DFA. So we want more exposure to these factors and try to capture more of that premium. So the right way to think about it is to think about how much cost are you paying for a unit of exposure to premiums. Because we looked at it that way, we made the decision to use the DFA fund 20 years ago. And over that 20-year period, since inception, you can look at the DFA fund has outperformed the Vanguard fund. I think the longest data is about 50 or 60 basis points, despite the fact that it costs about 40 basis points more.
Right.
And today, the Bridgeway fund is even smaller, more value, costs about 8 basis points more, but we use it for that reason. In every single case, the DFA funds have outperformed similar funds to Vanguard since their inception. And in, for example, emerging markets, Vanguard doesn't have a small and value fund, and DFA does, and the premiums there have been large in the area of maybe it's 3%. So people can bite the nose off to spite their face in saving maybe 20, 30 basis points in expenses and giving up 2 to 3% maybe in return. So again, what you want to look at is cost per unit of exposure to the factors and what that premium you expect is.
Totally agree, Larry. I think that with the amount of attention that costs get in the media, this is sometimes a hard message to get across to investors at the end of the day.
Yeah, exactly. And that's why I like to use that analogy about taking your spouse out to dinner on your anniversary. I don't think you get very far with that. She wouldn't appreciate going to McDonald's. So we don't treat that the same. We buy cars. We don't always buy the cheapest cars. What you're trying to do is spend money to get the most value. And so the job of a good advisor is to choose the fund that they believe delivers the most value in the context of the overall portfolio.
So, Larry, I want to finish with a question that we ask all of our guests. I've known you now for pretty close to 17 years, I think. And the first time I reached out to you, you agreed to come and speak to our clients because you saw that we were all on the same kind of mission together. So clearly you've been on a mission now for decades to change how people invest and plan for their futures. How do you now define success in your own life that you've had this great career behind you, and I believe you're transitioning into some form of retirement?
Trying to plan that, but one of the things I counsel our clients is you don't want to retire from life. And so you have to figure out, as we talked earlier and about the first chapter, planning a life in retirement. I'm gradually moving in that direction. I've cut my travel down. As you get older, just becomes a little bit more tedious. But the way I think about it is this: the day I feel I'm going to work will be the day I retire. I don't feel like any day I wake up I'm going to work. I love what I do. I enjoy the research, the intellectual stimulation get from that, and the writing, and the fact that I know I'm helping people have a much better chance of achieving their life and financial goals. That's what our clients have told us. I've made great friends like you and Ben over the years all over the world. I get emails pretty much every week from somebody somewhere around the world thanking me after they've read my books and my blogs. And there's no greater reward than that, even though I will never see these people or know them. But just knowing you help. As an old saying, it's much better to give than receive. The giver receives much more, and I feel blessed that I've been able to make such great friends like the team at PWL and many others around the world, and to help so many people. And I'm happily married now for 45 years, 3 great daughters, 6 great grandchildren who I've been able to help and positioned to have a great life, and they're all financially secure and chosen careers that they would enjoy and didn't have to worry about making money because they knew they would inherit a lot. That gave me great comfort. One of my daughters was a school counselor. Another is a Pilates instructor who's now been able to open her own studio because she's had some help on that front. And my third daughter was an event planner, and they're all happily married and have kids and don't have to worry about putting food on the table. So I define success by those things that my family and my kids, and maybe most importantly, the biggest sign of success is I actually have a conference room in Ottawa with my name on it.
We say your name every single day, Larry. I mean, you had such an impact. We did name a meeting room after you. So every day we mention Swedroe in this office many times.
That meant a lot to me, I assure you.
Well, you have had a huge impact on us. And I think back to the first time I reached out. And you remember what your deal was for you to come and speak to clients?
Yeah, that you had to take me out and we did some great whitewater rafting.
That's right. So that was the deal. You weren't in it for the money. I think we made a donation to a hospital in your name, but you weren't in it for the money at all, and you loved it, and we appreciate everything you've done for us over the past 16, 17 years.
It's been my pleasure working with you. I know we're all in this. Our mission, when you walk into our office, it says, do the right thing. We don't get paid by anybody except our clients. There's no commissions. The only thing we sell is advice.
All right, Larry, this has been fantastic, and you're truly a legend in this space, so it really is a pleasure to speak with you on the podcast.
It's been my pleasure.